Hey guys, it's Justin Goodbread here with Financially Simple. So last week, the stock market went crazy and had a lot of questions about why is it happening. In fact, Chris Steward, one of our CFAs, a chartered financial analyst, actually wrote me a paragraph that I want to kind of read to you from his take. Now, Chris, you can read all about him on our website, heritageinvestor.com. Go to Chris Steward's page and you can see his resume, and it is wow, the guy is impressive and he has a really good handle on what's happening in the markets. I wanted to give you some insight that he wrote out for me that I think is valuable. So last week, the coronavirus hit the news. And according to the CDC, there's been about 82,000 cases thus far with about 2,800 deaths. So that's a mortality rate of 3.4%. Now, in comparison, the flu season has seen about 29 million people get the flu with about 16,000 deaths, but the mortality rate is only 0.06. Now, one of the greatest pandemics of all times was the Spanish flu, which happened in 1918, and it killed about 30 to 50 million people worldwide. In the United States alone, that was 675,000 people who died from the Spanish flu in 1918. That's more deaths than World War I. The mortality rate was estimated to be between around 2 to 3%. So it's kind of in line with the coronavirus. So what do you do? I've been watching some of the, quote, experts on TV, and they say, the average the average face mask provides little protection outside the N95 respirator face mask. It's the only one that really provides the protection. So what we can do is wash our hands regularly, carry hand sanitizers, and as Chris said, he wants to curl up and watch Netflix and chill at home. Now, the equity markets reacted interestingly. It was one of the worst weeks on Wall Street since 2008, since the beginning of the 2008 financial crisis. The Dow Jones Industrial Average went down 12%. The S&P 500 and the NASDAQ both lost about 11.5% last week. In trying to rush to quality, as Chris said, the U.S. 10-year Treasury bond yield declined more than 30 basis points last week alone, down to 1.116%. which is a new historic low below the July 2016 1.37% yield. Oil also fell nearly $10 a barrel, down to $43 a barrel. So why are the markets moving so quickly? It's hard to say. There wasn't really any significant negative news about the coronavirus, but uncertainty, as we've seen from the financial markets, can cause a lot of problems, and it brings a lack of confidence in the marketplace. Now, some blame the momentum for traders pushing the markets. In fact, Monday alone, the stocks declined below their 200-day moving average. You want to watch this indicator. Now, one of the reasons for the equity sell-off was Goldman Sachs research report that there will be no earnings growth in the U.S. this year due to the impact of the coronavirus. I'm not sure about that, but that's what they say. The reason why I'm not sure that's going to happen is because oftentimes the experts are wrong. Okay, Goldman Sachs' forecast was based on the coronavirus becoming widespread, which the report warned could cause a recession in the United States. What do you do now then? What do we do with our portfolios? Well, we got to add some perspective to this, okay? The S&P 500 has lost only about 5 months worth of gains, taking us back to October 2019 levels. It's not the end of the world. In fact, for the last year, the S&P 500 is up 5.4% and 10.2% annualized over the past 4 years. And it's in line with our long-term averages. This has been the longest bull market in U.S. history. So just perhaps we're due for a correction. Now, I personally didn't expect the correction to happen so quickly, okay? It's human nature to want to measure our returns from the most recent peak. It is, I get it. My portfolio was just this value and now it's this. And it makes the downturn feel a little bit more painful. We've been tracking some of the portfolios that we manage. We have an 80-20 portfolio here that has a downside risk of 12.6% and an upside potential of 20.7%. Now, is that a guarantee? No, but it's something that we measure from a volatility perspective. I'm not certain what this week's going to hold for us. The markets are opening right now. I'm not sure what it's going to hold for us. I don't know if we're in a new bear market or not. So what am I going to do? I'm going to stay the course with my investments. You know, I have some cash that I'm fixing to deploy into the market. Yeah, I said fixing. Welcome to my southern idioms. I'm going to buy a little bit more of equities. I'm going to buy a little bit more maybe energy stocks. I hope we avoid a pandemic and a market meltdown, but I'm not panicking. I'm not worried about it. You say, well, Justin, I am. Well, perhaps, just perhaps now it's time for you to do an assessment of your plan, your financial plan, and see exactly what return you need. Now, look, I'm going to leave you with this. The last time influenza scares like the SARS of 2003 and the 2009 swine flu, okay, the markets declined bottom near the beginning of the outbreak. I don't know what this one's going to be. It could be different. I don't know. I wouldn't bet on it. Chris reminds us of this. Mark Twain said, history repeats itself. I'm sorry, history doesn't repeat itself, but it rhymes. Hey, look, friends, the bottom line is this. Make sure you're planning for these type of situations. If you're concerned about your portfolio, reach out to us. One of our certified financial planners would be more than happy to have a conversation with you to see if your portfolio is coronavirus proof. Guys, go out and make it a great day.